Hello and welcome to our presentation. We are the CornellMFE team and we will be walking you through our strategy for the CQA challenge. We have 4 members, Colin, DH, Shankar, and Connor. So first, our objective is to maximize the Sharpe ratio of our portfolio. To do this, we will go through our investment philosophy, how we constructed our portfolio, and then what our return and risk expectations were. Finally, we will conclude with our portfolio attribution, risk, and returns. First, I will discuss our investment philosophy. For the first half of the competition, we adopted a more value-based investing style where we place more long-term bets on stock movement. So basically, we invested in stocks for longer periods of time to minimize the transaction costs. We believed that the true value of companies would emerge, and we didn't want to be constantly reacting to market noise and minor fluctuations in the stock price. So this basically stemmed from a belief that the market is extremely efficient in incorporating news developments due to the wider use of things like NLP and other advanced parsing technologies to quickly incorporate information into the stock price. So we believe that placing long-term value bets would be a good way to realize returns. So we ended up filtering through the stock universe and picking stocks whose price to equity, price to cash flow, and price to book ratios were more reflected that the stock was undervalued with respect to the respective industry. After that, we did more market research and we evaluated macroeconomic trends before making a final investment decision. However, we soon realized with the short-term nature of the competition, the bear market, and all the China trade conflict, there was a very volatile political climate that we wouldn't be able to capitalize on our value bets. Also, we lost a lot from PCG because of all the California fires they started, so that ended up in them sort of declaring bankruptcy. So we knew that we needed to change up our investment style so that moving forward so that we could capture these moments. For the second half, we did a more robust screening process. This involves screening stocks using technical indicators, and the value indicators we use remain the same. However, we added price momentum and oscillator indicators to the list. For price momentum, we compared the SMA 20 and the SMA 200 in combination with the Bollinger Bands to be able to analyze short-term investor sentiment and actions. We used the RSI oscillator as well to sort of get a better idea of the stock's momentum. We also took a deeper look into stocks at 52-week highs and lows because we figured that there was a statistical likelihood that they would revert to their mean prices. We also decided to take a deeper look into industries that were minimally or negatively correlated to minimize volatility. We decided to take a more active approach and did sort of more weekly assessment of our top performers and losers so that we could reevaluate our positions on a weekly basis. So there were a couple of alternative ideas that we discussed, but then we discarded for a couple of reasons. The first was a market DCF, and with a market DCF, we would have to sort of project out all of the major line items, and we'd have to estimate perpetual growth rates, conduct sensitivity tests, and we'd have to do that for every stock. So as a team of 4 with the requirements of an 80 stock portfolio, we discussed that we couldn't really have the time or resources to do that. We also considered sort of a quantitative portfolio optimization method like Trainer Black, but there were too many issues for this. Weightings demanded by the optimizer could fluctuate out of range of the competition parameters. There were lots of transaction costs that could get really high, and it could also just take too much time for a team of 4. So we also discarded this idea.
Capitalization weights is generally the industry standard, but we chose to go with an equal weighted approach for its key advantages. We examined historical data and realized that the equal weighted index funds outperformed their market capitalization weighted counterparts. An equal weighted S&P 500 portfolio outperformed the standard S&P 500. The standard S&P 500 is more prone to large movements from its top holdings due to that the top 10 weighted companies in the S&P make up 20% of the entire index. An equal weighted approach was more diversified rather than heavily concentrated into just the performance of its largest companies. This naturally results in a more value investing approach, which aligns with our investment philosophy. Another reason that we believe equal weighting to be stronger is that individual stock returns are right skewed with large kurtosis. To improve our portfolio return, we wanted to keep an equal exposure to our basket of stocks so that we would not underweight a stock that performs significantly better than the market. Since smaller cap stocks have, in the past 10 years, outperformed larger stocks, we wanted a greater exposure than what we would have had with a market-weighted approach. Our initial philosophy in the first half was to take a passive investing approach and not to react too quickly to news about our stocks, then hold through the bad times and ride the upswings. We experienced some issues with this ideology. For example, PCG was included in our portfolio, and despite seeing the news about the California wildfires, we chose not to react and keep it as one of our stocks. This resulted in a major loss of over 25%. For the second half of the competition, we decided to take a more active approach, where we would meet weekly to screen all the stocks in our portfolio and look more into stocks that significantly underperformed and outperformed our expectations for that week. In addition to weekly meetings, we would also follow earnings reports and other major events that would affect our positions. For those stocks that underperformed, we looked into the possible reasons that could explain this and make a decision if we should cut our losses short and consider a replacement candidate. Similarly, if that stock performed very well, we often would cash in our gains by closing out the position.
So when the competition started, there were several macroeconomic factors that were looming in the market. First, the US trade war had recently started with China. Second, the oil prices were substantially increasing through time. Third, the Fed had already gone through a couple of rounds of rate hike and the market was expecting further rate hikes. Subsequently, the VIX index had almost doubled, as a result of which the S&P 500 and the Nasdaq were trending downwards, and which was driving up the fear of recession. On the positive sides, the unemployment rate was dropping consistently, and there was a steady growth in wage. Hence, we took a sectorial approach to construct our portfolio. Because of the Chinese trade war, we expected the semiconductor sector to take a significant beat down. The interest rate hike made us take a negative bet on the financial sector. Close to all-time low unemployment rate and steady rise in wages led us to believe that the consumption in the economy would increase, and hence we expected the consumer goods and staples sector to get a positive push.
As of February 7th of 2019, our portfolio is net positive in 1.35%. In comparison, an S&P 500 ETF is negative 0.87%. From this graph, our top contributors to portfolio returns came from our positions in energy, consumer staples, telecommunication services, and utilities. In these sectors, our portfolio contains net short positions in energy, consumer staples, and telecommunication services, and net long positions in utilities. Our underperforming contributors to portfolio returns came from our positions in real estate, industrials, and financials. Our portfolio has a net short positions in real estate and financials and net long positions in industrials. Our portfolio had an active return of 0.93%, of which 1.83% was from specific stock returns and negative 0.9% were from factor. In particular, the contributions to active returns by style had size factor with the largest contribution with 0.71% and lowest contribution from the exchange rate sensitivity factor with negative 0.26%. This corresponds to our portfolio positions in which we are mainly invested in large cap multinational companies. On behalf of the CornellMFE team, we would like to thank you for your attention and time. We would also like to thank the CQA organization for hosting this competition. This competition was a great learning opportunity for us. We especially want to thank Mr. Mark Weimer and Professor Victoria Aberbuck for mentoring and supporting us. Thank you.